I'd just like to welcome Paul Bloxham, who's going to be our speaker tonight. Paul is the Chief Economist at HSBC and Managing Director of Global Research, and formerly was an economist with the RBA. He's a regular commentator on local and international business television and a sought-after speaker and author for his opinions on economic activity and Australia's interaction with global markets. I guess the purposes of the Q&A is just a bit of a value add to our investors, get you in the room together, understand our values and the businesses. Catch Cry is real people, so just get to know the people that you speak to on the phone or interact with via email on a regular basis. So we like to just get out amongst the major capital cities, interact with our investors, and welcome you to evenings tonight. So, like tonight. So, Paul is a sought-after forecaster. He can't tell you who's going to win the Queen Elizabeth Stakes on Saturday, but he can give you some key insights into the economy. So welcome, Paul.
Well, thank you. Thanks, Andrew, and thanks for the invitation to speak to you tonight. Yes, so I am self-described. I'm a global macroeconomist. That's what I've been doing for the past 27 years. I worked at the RBA for 12. I've done 15 years now for HSBC. I'm part of a big global research team at an international bank. We've got about 500 analysts across the world that do various things. We've got 45 odd economists. They're the important ones and the ones that I keep track of. So what you're going to get from me is a few remarks about what's happening in the global economy and how we should think about what it means for us, because of course the shocks often come from offshore and that's what we have to watch. And then I'm going to talk about what it means for the Australian economy and drill down a little bit into some specifics around the property sector and the RBA and what I think is going to happen there. This view that I'm portraying to you is again sort of backed up by the team that I work with at HSBC in terms of a global view, and then locally, of course, I'm the one who sort of puts together all the views on Australia. And as Andrew said, I spent a fair bit of time talking to people. I used to work at the RBA. I travel a fair bit and talk to clients as well, and a lot of that sort of feeds into the views that I carry about things. I have spent most of the past year, and it certainly is the past year at the moment, opening my remarks by talking about one particular person, and you can probably guess who that is, and that's the President of the United States, Mr. Donald Trump. And so before he was elected through last year, he was starting to enter into the conversations I was having with people. And they were saying, what does it mean? What would it mean if Donald Trump was elected and so on? And there were two phrases that I would use at the time through last year. I said, if he's elected, we're going to get big change and considerable uncertainty. Those were the two things I said. But economists like to, of course, say things that you can look back and say, well, that turned out to be right. So I think everyone would agree. We've had big change and it's created considerable uncertainty. Certainly, Donald Trump has dominated the headlines in terms of the global economic story. The hard thing, I think, for most observers general observers, is to work out how much is noise and how much is signal, how much is stuff that's actually going to make a big difference to the economy, and how much is stuff that's just noise that you can effectively dismiss. So the broad view that we took once Trump was elected was that the collection of policies that he was proposing to deliver, and in fact has delivered a large part of those policies, would have certain effects on the US economy and the global economy. And I guess here are the sort of four key takeaways that we've been working with. The first one is we don't think that what Trump is delivering in terms of policy is going to be particularly good for US growth. We think US growth is going to probably slow down as a result of the policy measures that he's delivered. You might ask, perfectly reasonably, why hasn't US growth slowed down yet? And we'll talk about that in a moment. I think this is a feature of what we're going to see playing out into 2026. We've also pointed out, I guess the view we've carried is that the policy measures he's delivering are likely to see US inflation rise a bit more as well. US inflation is going to be a bit higher as a consequence of the policy measures that he's delivering. So not a great combination when you think about it, sort of slowing growth and higher inflation. This is not ideal. What it might mean for the rest of the world, I guess the primary thing we're working on is that what he's delivering, if it slows US growth and it also lifts the trade barriers so the rest of the world can't sell as many things into the US market, it's probably going to slow down global growth a bit as well. And again, I'll tell you a bit about why it hasn't happened yet, but why we think it will. And as far as what it means for the rest of the world, it probably means more disinflation. That inflation turns out to be lower as a consequence of the policy measures he's delivering rather than higher, in part because you can't sell as many things into the US economy. The US economy is slowing down and the global economy is slowing too. So looking into next year, we think global growth slows, but we don't have in mind something catastrophic. We don't think that there's a recession or a US recession, just a slowdown in global growth. But US inflation higher, global inflation slowing a bit more. What am I talking about when I talk about Donald Trump's policies, the things that he's delivering? Well, there are sort of 5 key things that I think of, 5 key baskets of things that Trump has been delivering. The first one, always I speak about and end up speaking way too much about, because actually it's the one there's been so much change and so many things going on. And that first policy element is tariffs. Donald Trump is self-declared tariff man. He has told us that he thinks tariffs are the most beautiful word in the dictionary, and he has been using tariffs very actively to try to achieve lots and lots of objectives. He believes that they are a multi-purpose tool. You can lift tariffs to narrow the trade deficit, to bring back the manufacturing jobs. You can lift tariffs to bring in more tariff revenue. Now, that's true, that's for sure. That tariffs can be used as a device for making other global negotiations, like trying to end the Ukraine war, or the Russia-Ukraine war. He is a believer that tariffs are a powerful tool that he can use, and he's been using them very actively, as you know. He said from the beginning he would, and he has. So if you go back very sort of briefly through the history, and on Inauguration Day at the end of January, he said he was going to have this day called Liberation Day on the 1st of April, where he was going to announce a whole range of tariffs across a whole different set of countries, which he did duly. And the Rose Garden, if you remember, he held up 2 boards with all these tariffs that he announced. The market didn't like that very much. The very high tariffs he announced on Liberation Day, the market responded poorly. Equity markets sold off, bond markets sold off as well. And of course, within a few days, he kind of had to back down. And he did. He put the US into a negotiation mode where they were negotiating with the rest of the world for 90 days. And then they came to the end of July and did negotiate a set of agreements with a whole bunch of countries. The marker is that the 7th of August is when those tariff rates mostly kicked in. And the import tariff rate, or the average import tariff rate into the US, rose quite sharply from sub 2% prior to inauguration to more like 17 or 18% as of the 7th of August. He's more recently agreed with China about some numbers, and the import tariff into the US from China at the moment is 47% for what it's worth. But the bottom line is those tariffs have gone up. They've gone up quite substantially, and I think that our view is that they are going to weaken growth. If you lift the price of imported goods, it does weaken your growth, and we do think it will start to feed into more US inflation. So one of the questions is, why hasn't that arrived yet? And I think one of the primary stories there is that there's been an enormous amount of front-loading ahead of those tariffs. Businesses knew they were coming. They were told there were going to be higher tariffs. The tariffs didn't arrive, however, until sort of the earliest of the big numbers was the 7th. The big deals were set on the 7th of August. So ahead of that, they pulled forward all their imports. They stocked up on their inventories. They got ahead on the supplies they needed at the lower prices before the tariffs applied. That's lifted activity in the US. It's kept inflation actually fairly contained because they imported things before the tariffs arrived and so on. And it's supported global activity as well. Trade from other countries has been well supported by this factor. So what that also means is once the tariffs arrived, the next set of imports that come through are going to cost more. They're going to be at a higher tariff. They're going to face the higher tariffs. You are going to see, I think, that feed through to weakening US growth running into next year. And I think you're going to see it feed through to inflation that rises as well. I said I'd try and keep my tariff remarks brief. There are 5 things I want to touch on. I'm going to move on to the second one. The second one is, in the Trump list of things he's doing, and it's really big actually, is migration policy. He's doing a lot on migration policy. He's been constraining inward migration. He's been trying to stop illegal migrants from coming across the US border. He's been removing some undocumented workers from the US economy. One statistic you should carry around in this space, and that is 6% of the workforce in the US is undocumented workers, which is an enormous number when you think about it, a truly enormous number, a lot of undocumented workers in the US. If you constrain the supply of these workers or remove some of them from the economy, then you have to find other workers to do the work that they're doing, and you are likely to have to pay higher wages for that. So I think these 2 forces that I've described so far, higher tariffs, constrained inward migration, are things that are essentially constraining the supply of the things you need to grow the economy. They're going to weaken growth and likely lead to higher inflation. The third thing he's introduced is something called the One Big Beautiful Bill Act. Yeah, it was called the One Big Beautiful Bill before it was legislated, and once it became an act, it became the One Big Beautiful Bill Act. That's very clumsy, but that is what it's called, right? It's a $4.5 trillion spending package over a decade, so it's enormous. It's mostly an extension of the high income tax cuts that he introduced back in 2017. They were supposed to end in 25. He's rolled them forward. So it's mostly a boost to incomes at the top end of town. It cuts back on access to Medicaid. It unwinds a lot of the energy transition related policies that the Biden administration had put in place in the Inflation Reduction Act. So it slows down the energy transition. But the primary way to think about this is it's a big dollop of fiscal spending, a big boost to the economy at the same time that they're constraining the supply of the things they need by cutting back on inward migration and lifting tariffs, right? So I think, it is going to support growth to some degree, but I think it's also going to support inflation. A fourth element of what he's been doing has been deregulation. This is good stuff mostly. I mean, this is good for growth. He's been deregulating parts of the financial services industry, and that's led to more mergers and acquisition activity in the US. He's been deregulating such that oil and gas companies can drill and extract on federal land, and that's supporting growth in that industry as well. Not necessarily good for the energy transition, but nonetheless good for growth in a principal sense. And the fifth thing is the Department of Government Efficiency. So this is what was Elon Musk's project. And essentially what that is cutting down on the public service. Now, that may all sound grand, but the challenge there, I think, is that will slow down the pace at which public services are delivered and so on. So our net upshot from all of this is US growth likely to slow into next year, US inflation likely to remain a bit more elevated, the Federal Reserve, the US central bank, unable to cut interest rates quite as much because, of course, if inflation's rising, they don't have as much ability to be able to lower interest rates. I've talked about the US. What does it mean for the rest of the world? Well, I've kind of already told you. We think, in principle, if you lift the trade barriers and you can't sell as much into the US market, the rest of the global economy weakens somewhat on the back of that. That hasn't happened yet because primarily what's happened is there's been a pull forward of imports into the US ahead of the arrival of those tariffs. But we think running into the final quarter and into 2026, you are going to see some weakening in global trade, some weakening in growth in Asia in particular, and that's going to slow down global growth. If you think about what I've described so far, for the US at least, primarily what's been delivered in the form of these policy changes is what I would call a negative supply shock. They've constrained the supply of the things they need to grow their economy. They've constrained the supply of workers. They've constrained the supply of the imported goods that they need by lifting their prices. For the rest of the world, though, this is mostly a negative demand shock, right? It's slowing down global growth. You can't sell as many things into the US market as previously. Negative supply shocks are hard to deal with because you can't just cut interest rates. Negative demand shocks, you can start to lower interest rates, deliver more fiscal stimulus. So it will be quite helpful, or it'll be easier for the rest of the world to deal with this in terms of providing support for their own growth. Okay, so let's move on to what this means for China, and then I'll bring it all back to what it means for Australia. For China, this is not overly helpful because the US is a big market for selling their product into selling Chinese manufactured goods. But China has so far dealt with this quite well. And part is because they had a lot of time to prepare. They knew through the 4 years in between the 2016 through 2020 term of Trump that if he was reelected, probably there would be more trade tensions. And they geared up. And they geared up in a way that allowed them to, one, use a few tools to try and negotiate. One of them has been to stop buying soybeans from the US, which is a big factor for the US because that's one of their big exports to China. And of course, a lot of it's produced in the Midwest where there are a lot of Republican voters. So that's been one tactic that they've used. Another tactic they've used is to constrain or sort of build a system that allows them to constrain the supply of rare earths, which they produce almost 90% of the world's rare earths. And these are a key input into the production of permanent magnets that go into military material and electronics and so on. So they've been able to use these bargaining chips as strong bargaining chips in terms of their trade negotiations with the US. The other thing they've managed to do is divert a lot of their exports. What they used to sell to the US, they're now selling more and more into other markets. If you look at the trade numbers, the latest trade numbers, exports out of China have grown by 6%, which is actually pretty decent growth. But if you look under the surface, what you find is over the past year, their exports to the US have fallen by 27%. And it's been more than offset by increases in exports to the Southeast Asian nations, to Africa, to LATAM, and to Europe. they've managed to divert a lot of their trade to other markets. And so far, that's continued to support growth in China. But then if you look a little bit harder, what you find is this is the thing that's been driving China's growth of late. And the domestic economy in China is actually facing some pretty hefty challenges. And one of the big challenges China's faced over the past few years is it had a very, very big property bubble that burst back in 2020. And that property bubble is still rolling off. It's still running off. Property investment has now fallen for 5 years consecutively. It's down by 60% from its peak. It's still falling at a double-digit rate. So the challenge China faces is, at the moment, their growth engine, their primary one, is producing manufactured goods and selling them into the global system. But they're not going to be able to do that in the same sort of way, given the trade tensions that I've just described. And the rest of the domestic economy has got a pretty hefty challenge. The property sector is still very weak. So for China, the issue is how to grow from here. If it's not going to be about manufacturing investment and it's not going to be about exports, and it can't be about the property sector because you've built too much property already, how do they grow from here? What's the next growth story? Almost certainly the next growth story for China is going to be more and more about getting the consumer to spend more. China's big driver of growth is that they're a large producer and a large investor, and they save a lot. And they export a lot to the world, and that's how they've grown their economy. They don't actually spend that much themselves. They save a lot rather than spend. Consumption is a fairly small share of GDP in China. It's only 40% of GDP in China. So what they've got to do, or find a way to do, is try and get the consumer to be a larger source of demand for that economy. And so that's not going to be easy. The property sector's weak. It's hard to get consumers to spend more when property prices are falling. Demographics are poor. Their population is shrinking. And so you've got fewer consumers every year. And the social security network's fairly limited as well. But I think that is going to be, as we go forward, what drives more and more of China's growth. China's growth is probably going to slow somewhat, but it's also going to be more and more about the consumer. Okay, so I've told you a global story, and I hope that I haven't spent too much time on it, but I've talked about what Trump means and how to think about it in terms of what it means for the global economy, and I've talked a bit about China. I haven't talked about the rest of the world. If you want to talk about that in questions, feel free to ask me, because we can talk about all the others, India, the rest of Asia, we can talk about Europe, there's lots of things that we can cover, but I want to move on to sort of contextualizing what all of this means for Australia, how to think about what it means for Australia. So the first remark I would make is we are not particularly directly exposed to US in terms of trade. And so the trade disruption so far, the trade tariffs, have not had much of an impact on Australia. They haven't fed through to business confidence or weaker consumer confidence. And to me, that makes sense. Only 5% of our exports go to the US. We're facing only a 10% tariff. So actually, it's pretty low compared to a lot of other countries. There's been a pretty limited effect of those trade disruptions coming through to the Australian economy. The primary way the global economy is going to affect Australia is through the impact of those trade policies on China. I mean, that's our largest export market. We sell a lot of commodities into the China market. That's the big story, is what it means for China. So far, China's held up reasonably well. That's a positive story. But the challenge, I think, is as we go forward, for Australia in particular, is going to be that the shape of China's growth is changing. It's not going to be as much about property, and it's not going to be as much about manufacturing investment as it's been in the past. Those activities are very metals intensive. They use a lot of steel to build a lot of property. They use a lot of steel in the manufacturing process. As their growth becomes more about consumption of services and less about the building things, essentially, they're not going to need as much steel. And that is Australia's big export. Our big exports are iron ore, coal, and gas. That constitutes 60% of what we export to the world, and primarily we sell that stuff to China. Now, that story, China's emergence, the big period over the last couple of decades where China needed to build more property, needed to build more infrastructure, and was building more manufacturing capacity, was the prime mover that lifted Australia's living standards. It was the thing that made us wealthier over the past couple of decades. In fact, made us very wealthy. We are probably one of the countries that has benefited the most from the emergence of China. You know, if you list off the countries, we'd be near the top of the list, if not at the top of the list in terms of benefiting from China. And the primary driver there was China's demand for iron ore, coal, and gas. Right? Resources exports, the value of our resources exports rose between 2003 and 2023 by 750%, which is a truly enormous number, a really enormous number. We got a really, really big lift in our national incomes from the rising price of these commodities. We invested in a lot of capacity in the early part of the century to produce more, so we sell more volume of these products as well into the global system. That boosted national incomes, lifted the Australian economy wholly, boosted the mining sector profitability, boosted the tax take, boosted employment, drove the whole economy. But what I would claim, or what I'm trying to tell you in principle, is that boost to the economy is pretty much done. The shape of China's growth going forward is going to be less steel intensive than it's been in the past. I don't think India, Indonesia, Vietnam, or Brazil are going to fill the gap sufficiently. I think we are probably past peak steel in China. So the demand for iron ore is peaked in principle, right? So if that's the case, we're not going to get more of a kick from rising iron ore prices or more of a kick from rising iron ore export volumes. In terms of the coal story, well, thermal coal is, the world's making the energy transition, and the Chinese themselves are building a lot of thermal coal mines, so they're not going to need as much seaborne thermal coal. That's why coal prices have fallen. And if the world isn't going to make as much steel because it doesn't need as much steel, because China's past that part of its growth story, we're not going to need as much coking coal either. And so that story is a bit harder. Plus, we're not investing in capacity to produce more coal anyway. And then gas, well, the world is investing in gas in other places. They're investing in Qatar, they're investing in the US, they're investing in Canada. There's a big amount of gas coming on stream into the system. LNG is coming on stream in 2026, 2027, coming out of Qatar. We're not going to get a boost from that source either. So the short version is the resources boom that drove a lot of our national income strength probably peaked around 2022, 2023, and is now in some sort of decline. It's not going to drive growth going forward. So there are two ways to lift your incomes in your economy, in principle, right? Two ways, macro. There's no others. There's two. One, get a great gift from the rest of the world of an ever-increasing price for the product that you sell to them. Get lucky, right? And that's kind of what we've gotten. We got a price rise for all the products we sell. Does anyone know what the iron ore price was in the year 2000? Anyone remember? I asked this question, by the way, in Western Australia, and they don't all know either. So don't feel too bad. $10, right? It's been consistently above $100 for the last 17 years. So we had a 10-fold pay rise for that one particular product, which constitutes 20% of our exports and 5% of our national economy, right? We got a 10-fold pay rise for that product, but it's not. If it doesn't go higher, we're not going to get more. If we don't build more mines, which are not, we're not going to get more volumes, and the world doesn't need more of this stuff either. So just as an example, that story's done. So if you're not going to get that boosting your national incomes, there's only one other way to lift your living standards, to lift your per capita incomes. That is to be able to produce more output for the inputs you put into the economy. That's the only other way to do it. Lift your output for the inputs you put in. And that's what economists call productivity. And once I say the word productivity, eyes often glaze over, but that's what I mean. What I mean is how much output you get for how many inputs you put in, right? And most of us would measure it based on something called labor productivity. What we would say is count up all the GDP, all the output you produce in the economy, divide it by how many hours are worked to produce that output, and that's what we call labor productivity, output per hour worked. It's pretty straightforward, actually. So how has that indicator been tracking? How has our output per hour work been tracking? Given we need it to lift, otherwise we're not going to lift living standards going forward. How has it been going? It's been dismal. It's been awful, terrible. I don't know. There's got a lot of other sort of ways you can describe it, but those are the polite ones. It's not been very good, right? Over the past year, it's basically flattened out. Over the past 3 years, it's actually fallen. We've had less. So you go back 3 years, if you put in the same number of hours now that you did 3 years ago, you get less output now for those hours you put in, right? Productivity has fallen. If you go back far enough, it did rise, but it's basically the same level right now that it was in 2016. So we've had 8 years of no productivity growth in Australia. And that's the engine that we need to lift our living standards. If we don't do that, we don't get to lift per capita incomes. That doesn't mean the economy is not growing. It has been growing. It's been growing because we're getting more people. So we're growing population. We need more. We get more demand as more population comes in. We've got more workers. We need more services. We need more infrastructure. We need more housing. All that stuff drives the economy to grow, but it doesn't lift our per capita incomes. We don't get to lift our living standards, as it were, without driving a pickup in productivity. Unless, of course, we get lucky, which I don't think we're going to. That's what I'm arguing. It's all about productivity going forward, okay? So that's the challenge we face in Australia. Was this the conversation we had at the election? Did one major party get up and say, Australia's biggest challenge is that productivity is going backwards, and if we don't fix this, we're all going to be immiserated and poorer in the future? Did they say that to you? No. Did they say, that's the biggest problem, and here's the list of things I'm going to do about it? And then the other party got up and said, we accept that that's the problem. Here's the list of things we're going to do about it. And then we got to choose between the two. No, that wasn't at all what the election looked like. And I was so disappointed. I mean, I wasn't surprised, but I was disappointed that that's what happened. The election was, one party said, households, we're going to give you lots of money. Here it is. And the other party said, we're going to give you the same amount of money and maybe a little bit more. Vote for us. And that was the conversation, unfortunately. That was the election conversation that we had in Australia. It wasn't very edifying. The day after the election, we were told by the Treasurer that we should focus then on productivity. And I said, yes, absolutely we should. And I'm very glad there's an acknowledgement that we should focus on productivity. But the challenge is a lot of the things we need to do to fix productivity are big things. And so they need an electoral mandate to be able to do them. If you want to do large-scale tax reform, you need to take it to an election. If you want to really get deep into competition policy, you probably have to take it to an election. If you want to do stuff on the industrial relations system, you've got to take it. The challenge is that we just had an election and we won't now be able to do a lot of the large-scale reform, probably until we get to the next one, assuming that they take an agenda that's got those sorts of things to it. So the bottom line is we're probably going to end up in an economy that has pretty low productivity, right? And that productivity is going to constrain the pace at which we can grow the economy, okay? So with that in mind, and I can go through all the things I think we should do. I mean, we should look at the tax system, we should look at the competition environment, we should look at the industrial relations system, we should look at the regulatory environment, all these things that were talked about in Canberra in August. There was a big national, convention. They had a 3-day discussion on all sorts of things, 900 submissions from the public. They had 10 big things they said they're going to do that they were already doing, and 10 big things they were going to look into doing, and we'll see how much progress is made on those things and so on. So what does this actually mean for us? How does it manifest itself? Well, I'll tell you how it manifests itself. It means that the small pickup in growth that we've seen in the Australian economy in the past 6 to 9 months or so, we're in a modest upswing right now. Growth has picked up. The consumer started to spend a little bit more. That little lift in growth that we've seen, pick up from 1.3% growth last year to 1.8% growth in the second quarter, even that little bit of lift in growth has been enough to start generating some more inflation. Because we're up against the supply constraints of the economy. We can't grow any faster than that. We're at full capacity. We're fully employed. You can't get things built. You can't get things done because we are already operating at capacity. And that's a manifestation of the fact that productivity is as weak as it is. We are in a supply-constrained economy, okay? So what I want to do now, having set the global scene, having talked about the local economy, is I want to step through the story I've just told you a little bit more, in a little bit more detail, the cyclical story, the one that most economists would get up and talk through. They'd put some slides up and show you and talk to you about GDP, they'd talk to you about inflation, they'd talk to you about interest rates, the housing market, and the unemployment rate. I'm going to do all those things, right? We're going to talk about all those. But I want to set the scene, okay? So how are we where we are? Why are we where we are, okay? So think back a little bit. As we came out of the back end of the pandemic in 2022 and we reopened our economy, the big problem we had was that inflation picked up to high rates. It surged, right? Remember? Inflation got to a peak of about 8% in 2022, its highest rate in multiple decades, and that was the big problem. That was the big challenge that we had. Why did we get a pickup in inflation? Well, the primary driver, not the only one, there were a few things going on, but the main one was this. Through the pandemic, the government gave a lot of money to households and businesses. They spent $350 billion in expenditure to support the economy through the pandemic. Lots of distribution to households, checks to households, JobKeeper, JobSeeker, all sorts of money going the household's way. They gave you lots of money and then said, you can't spend it because you can't do all the things you want to do. You can't go to restaurants, you can't go to sporting events, you can't go traveling, you can't go to the theatre, everything's closed, you can't do it. So what did you do with the money? You saved it. So households saved a lot more than normal so that they could spend it when they could. 2 years go by and then we get to 2022 and we reopen the economy and everyone starts to go off and spend. And they want to do all the things they haven't done for a while because they haven't done them for a while. They want to do it multiple times. You're going to go to a concert? No, I want to go to lots of concerts. No, I want to go to the football. No, I want to go every weekend. We hadn't done it for a while. So we saw this surge in consumer spending because, of course, we'd saved lots of money and we hadn't done stuff for a while. And that pickup in demand, strong pickup in demand, hit an economy that wasn't ready to deal with it because it was supply constrained, right? We closed the border for 2 years. We didn't have enough workers in the right spots. We had disruption from the pandemic that was still flowing through. Demand surged well ahead of supply. And when demand surges ahead of supply, inflation picks up. That's what happened. Now, at the same time, Russia invaded Ukraine and oil prices went up and so on. There were other things going on, but the primary problem was that demand surged well ahead of supply. So what happened? Well, this was a story across the world. The only way that policymakers really could deal with that, and the only way they could do it sort of with relative pace, was to lift interest rates. And that's what the RBA did. They lifted interest rates a lot, 425 basis points in 2022 and 2023, not quite as much as everyone else, actually. They lifted rates by less. They had an intention that we get inflation down, but they didn't want to deliver a recession. They didn't in the end, right? So they slowed the economy down by lifting interest rates, slowed down demand in the economy so that supply could gradually catch up. We reopened the border and got the workers coming back, and we got the supply side starting to remedy and fix up and so on. So 2023, growth slowed down. 2024, growth slowed down. Demand weakened, and eventually we got to the early part of this year, and the RBA judged that demand was almost back in line with supply. The supply had caught up, the demand had slowed down. It hadn't fallen, but it had slowed down, and we got back to demand and supply broadly almost in line with each other, and that was manifest in inflation coming down. It came down from 8% to 2.7% on the second quarter for the thing that the RBA focuses on. It dropped back into their target band, and as a result of that, they started cutting interest rates. They cut in February, they cut in May, they cut in August, 75 basis points of easing. And that 75 basis points of easing has been enough to get growth to start to pick up. Households have started to spend a bit more. Why? Well, one, because inflation's come down and their wages have now been outpacing inflation. So they've got a bit more income. Two, the government gave them tax cuts last year. So they've got a little bit more income anyway. Three, everyone's employed. The unemployment rate is still very low. It's close to full employment at the moment. So everyone's got a job, their incomes are rising, they've gotten tax cuts, and the price of things has started to fall below the pace of their wages. And in addition to that, interest rates have been cut by 75 basis points. That's been enough to get the consumer to start spending more. Consumption's been in a modest upswing. GDP growth has picked up from 1.3% last year to 1.8% by the middle of the year. And that was the story. That's the story that has been playing out. But what's revealed itself last Wednesday is that lifting growth has been enough to get demand to not start rising a little bit faster than supply. And so that is driving inflation, and that gave us the upside surprise last week to inflation, where the RBA thought that their preferred measure would fall to 2.6, and actually instead it rose to 3%. And that's because demand is picking up, but not that much. It's just that the supply side of the economy is really, really quite weak. We are supply constrained. Why are we supply constrained? I've told that story. Productivity is weak. That's the primary problem. How does it manifest itself in the way you can see? We haven't got enough housing. We can't seem to bring on enough housing supply because we haven't got enough workers, and because we haven't got a regulatory system that's allowing us to bring enough housing supply on quickly. We haven't got enough cheap energy because we haven't been fast enough at making the energy transition or delivered new capacity and so on. All these things are constraining the supply side of the economy. That supply constraint is the reason why inflation's starting to pick up, even though growth hasn't risen very much. Now, if you want to fix this problem, if we want to fix this problem, because of course we want to fix this problem, don't look to the RBA. They can't do anything else. They've only got one policy tool. It's an interest rate, the cash rate. They set that. That's all they do. And all they do is manage demand. They speed up demand or slow down demand by moving the cash rate around. If you want to fix this problem, look to all the other policymakers because they've got all the tools. State government, local government, they got to start doing stuff that's going to focus on lifting productivity. Otherwise, one, our living standards don't get to rise as much in the future as in the past. And two, we have to deal with the fact that interest rates don't get to go down much further either. Now, I told you I'd talk a little bit about the housing market at the end of this. Of course, as a result of everything I've just described, the housing market, house prices have started to rise, and quite quickly. It's quite surprising how much just a little cut in interest rates, 75 basis points really, it's not that much in the scheme of things, has turned the housing market around quite quickly. Why is that? Well, the simple answer is we haven't got enough housing. So if you gave even a little bit of extra demand, which you did by lowering interest rates just a little bit, that little bit of extra demand's come into a market where there isn't much housing, and it's pushing up prices quite quickly. So house prices are rising pretty solidly across the country in all of the different state capitals now. But I think that the pace that we've seen over the past couple of months might start to ease a little bit, because this upside surprise to inflation has meant that the RBA has signaled that they can't do anything right now. They've got to stop for a while. And my own view, for what it's worth, and my view is out in the public, and I wrote a piece for the newspapers, and I was on TV all week and so on, this week after the RBA meeting and so on, is I don't think they're cutting. Again, I don't think we're going to get a cut from the RBA. I think that this is probably about it. because the economy is already operating at its full capacity. We're already in a growth upswing. Inflation's already lifted. And so probably we're at the sort of limit. The RBA can't really go much lower. Now, there's a debate to be had, maybe in the second half of next year, which is kind of what others are talking about. Maybe they get to lower interest rates a bit further, but maybe not. Maybe actually inflation doesn't come down enough to allow them to do that. And a lot of the story is going to be, in my view, about this very weak productivity that's constraining the supply side of our economy. I hoped you didn't want me to bear too much good news. There's plenty of wine available at the table, I believe. So I'm going to stop there. I think I've used, well, certainly plenty of the time that I was allocated. I'm happy to take a few questions from the room. Please speak up when you do. I'm going to repeat your questions because we've got people down that camera who want to hear the question as well. So here, then there, and okay, that's it here. Yeah. I'm aware of the proposition that apparently AI is going to replace us all, but I'm not convinced that that's what's going to happen. So I'm happy to take it as a sort of proposition that I understand what the argument is, but I don't agree with that as the likely pathway. I think, if I look back through every other innovation that's come along through history, and admittedly, the people who, the tech experts will say, oh, AI is different, and we can come to that in a moment. But what tends to happen is we all get very worried that that innovation is going to come along and it's going to wipe out a whole lot of jobs, and then there's going to be no other jobs left. And that happened when we introduced motor vehicles. When we went from horse and carriage to motor vehicles, it wiped out about 30% of the workforce in the US because this is US numbers that I'm aware of, at least, because effectively you didn't need people to shod horses, look after horses, manage horses. We all went to driving cars, but it meant that still people got jobs. What happened is other jobs got created. People didn't have to spend as much time looking after horses. They could get around more quickly, and we could start doing other things. Think about other innovations. We got rid of typing pools. No one has a typing pool at their business anymore. They all used computers for a while, and now you don't do that. Now you just dictate your phone and actually does it all for you. Those jobs disappeared, but other jobs were created. A lot of jobs were created in other areas. And then if I think about the AI story, I think, yes, this is going to be another innovation that streamlines white-collar services, and I think that's where the effect's mostly going to have its impact, and so on. Strips out the need for quite as many lawyers or accountants, financial people, so on and so on. I think that's quite possibly the direction we're headed with this, but then that will improve the bottom line of those businesses. Somehow that'll feed back into the economy. It'll create other services. AI doesn't yet do physio services or look after older people. This is as the population ages, we're going to need more people in those services sort of roles, as an example. But I think there are going to be a lot of other jobs that get created along the way. And so I'm just not a subscriber to the idea that it's going to lead to a world where we don't need any workers. In that transition, there's a lot of questions. I mean, about who's going to get the rewards, because through previous technological innovations when they've come along, that's been one of the big fundamental problems, is innovations come along and the owners of the capital are the winners, and often there are large swathes of people that miss out, and that can be quite bad for inequality. And if you want to have a think about what, the broadest way of thinking about it is go and read Dickens. What was Dickens writing about? He was writing about the Industrial Revolution in Britain and the impact that was having, and the fact that the factory owners were the winners, but the people who worked in the factories were not necessarily better off from that innovation. The history of the world tells us we have to be super duper careful about when new technological innovations come along, that we allow it to appropriately, to manage the distribution and the winners and the losers.
So at the moment, there's a bubble going on with the whole AI visual cut back. When that falls, what effect will that have?
Oh, that's a wonderful question, and one that's pretty much unanswerable. It's unanswerable. I think that firstly, I am worried about pricing for tech, because I do think that we're at a point now where it's priced to perfection. The tech sector is priced for lots of upside to productivity that has to arrive fairly soon to justify that pricing. So I do acknowledge that actually we're at that risky, at some sort of a risky stage. These things can often run a whole lot longer before they actually start a correction. So getting the timing right is extraordinarily difficult. And then I guess the other, and then also working out who the winners are and who's going to lose from this in terms of even within the tech sector itself is quite hard. So I think we need to be on alert for this. But is it imminent? Is it happening immediately? No, it doesn't seem to be. How to play this in terms of what you do, in terms of
Specifically.
on Australian real estate. Yes, so it's a long bow, isn't it? It's a long bow. The primary ways to think about this would be, it would depend on how much it becomes a financial event as well. I think, in Australia's case, you would say we've got banks that have got lots of capital and they're well capitalized. We've got a floating currency that tends to protect us in the face of negative shocks that come from abroad. We're much more exposed to China than we are to the US. We're much more exposed to China's growth rate and what it can do, and they pull levers too to support their growth in the face of these things. That the exuberance in the tech sector is most vivid in the US equity market rather than other equity markets. So there's a lot of things that come into play that somewhat support that Australia might fare reasonably well through all of this.
So and he said I own 200 shares. So that reason.
Yeah, it also.
Wow.
Yeah, so we've got a large pool of capital sitting in the superannuation system that actually means we've got onshore saving that protects us somewhat. I mean, I think that's true. It wouldn't be my first step to say if the tech bubble bursts, you should worry about Sydney house prices. I mean, the connection doesn't seem to me to be an obvious, immediate sort of way of I'm not going to subscribe to.
Way more than that.
That's okay. No worries. It's normally the answers to the questions that are long rather than the questions. But was there more questions over here? Yes. Sure. Okay. So the question for the camera really, so that the people who are online is Australia's economy is a big resource producer, and we're a big consumer of services, and a lot of the productivity may come from tech innovations and AI and so on. How do we connect those things? Well, I think you connect them in some ways. You say, well, the provision of services in the economy, services is actually the biggest share of Australia's economy. 75%, 80% of what we do is services. Provision of those services can be better allocated, more efficiently delivered by using technology, using AI technology and so on. Provision of health services is one that's really becoming a bigger story for Australia as the population ages, the government spends more on it. Can we use AI to more efficiently allocate those services? And so that's the sort of way you might think about it. The tech sector is pretty small in Australia, as you would be aware. And the key for us is typically, and this has been the case through history as well, the key is to be able to be adopting the new technology fast enough that it can help us to lift the productivity across industries. Now, unfortunately, on Australia's, on the indicators that I'm aware of, at least, Australia has been slow at adopting AI, actually, relative to others. We have been quite slow in take-up of using this technology in terms of lifting, trying to improve processes. But that's definitely the direction of travel we need to be thinking about if we're going to use these devices for lifting productivity. And as I've said, explicitly, that is the fundamental challenge we face, lifting productivity. So when I talk about the idea that policymakers need to do things to help to lift productivity, it's not policymakers that actually create productivity, it's businesses. Businesses are the ones, right? They innovate, they invest, they find new practices. What we want policymakers to do is to set a policy environment that encourages businesses to do that. We want a competitive environment because businesses will do more things and innovate and invest if they're forced to by competition. We want a tax system that encourages them to, that's more efficient, that encourages them to. We want a regulatory environment that doesn't constrain them too much so that, it's not regulation that gets in the way of businesses being willing to make investment decisions and so on. You made a point that, the cost of labor is high, and that's actually one of the fundamental challenges is wages growth, where it's running at the moment, is running at a rate that's, if you adjust it for productivity, which is flat, which is zero, is too rapid for businesses to feel like making investment decisions. I mean, the cost base is growing too quickly. And so we need to find ways to lift the productivity of the workforce, as it were, so that actually we can encourage more of the sorts of innovations and investments that we need to lift productivity. Does that answer your question? No, it doesn't make your plumber cheaper. That's right. I mean, I guess the challenge there is, in all of this, we've got labor supply constraints. We are still in an economy that's operating at full capacity. The unemployment rate's still low. And I think when I talk to business, when the RBA does its survey of businesses, most businesses still say it's quite hard to find the workers they need. And I think that's reflected in the trades in particular. We are in a supply constrained economy. We need to work hard to try and find ways to remedy that. Otherwise, we won't be able to grow as quickly in the future as in the past. There was one in the distance. Yes. So I guess, the first thing is it's very difficult to get the timing right on these things. It always has been. And so what you look is for the telltale signs of exuberance, what Greenspan referred to as irrational exuberance back in the early part of the century, right? This is what you're looking for, telltale signs of exuberance. And one of the things you can look at is the price of stocks relative to earnings, and they're quite high. The PE ratios are quite high. And then you're relaying other things that tend to happen at the similar sorts of times where you get more frenetic sort of financial activity between individual players and so on. And so that's another sign that you're looking at this carefully, because it looks as though things might be getting ahead of themselves and so on. These are all telltale signs for watching out, for trying to work out whether it's overpriced or not. But I don't think it's easy to pick the timing or even the level of where at what point has it gone beyond. And I'll try to explain why. I mean, so AI, and I think most of the tech experts, and if you've looked at it yourself, you would know, is very impressive. And I think it is going to deliver productivity gains. We are going to get productivity gains from adopting AI. So if we're happy to agree with that, it is going to lift productivity. But the question is it going to lift productivity enough to justify the current pricing and soon enough to justify that pricing? Because right now the pricing suggests that very, very soon we're going to get a wave of improvement and in productivity that lowers the cost base for lots of businesses because AI is adopted and it's such a powerful instrument and powerful tool once it's adopted. And so that's the tricky thing, is working out. And then beyond that, we're talking about the aggregate, where you got to start looking at the individual firms that are leveraged into this. And some of the tech firms are big software producers and some of them are big hardware producers. Is the hardware going to continue to be in demand? Are the chips going to continue to be in demand? You'd imagine yes. Is the are the winner? Which are the winners going to be? And then what we've seen through previous tech bubbles, for what it's worth, the one in 2000 and the ones before, is that, well, it's not always the ones that are doing so well back then that are the ones that win in the end. WorldCom doesn't exist anymore. I don't think anyone's using Netscape anymore. Like these are, tangible examples of things that were highly valued at the point in time, but obviously disappeared once other innovations came along. So working out which ones the winners are is also tricky. I'm happy to, so that one and then that one, and that might be it unless you're really desperate for more, because I wouldn't mind having some dinner as well. There and there. Yes. So these are all watch points. I think, and if you're I think you might, is it private credit you mean? Private credit's expanding quite rapidly, yeah. I mean, I think this is something that we need to watch quite carefully. When there's new ways of arranging capital in markets, it always ends up being, and especially when it's outside, part of it can be outside of the regulatory net, these are the areas that you need to watch more carefully. The RBA is writing more about this in terms of their watching what's going on for financial stability. I mean, the main remark I would make is that this is still fairly small in Australia relative to, say, the scale of it in the US. Actually, the same would apply to the AI story, where, the tech stocks dominate the US story. They don't here. And so however you square this away, we seem to have less exposure to that overall risk, it seems, which is a very familiar story, because this is what happened in the IT bubble of the early 2000s, where we weren't particularly exposed. It turns out we weren't particularly heavily affected. It turns out that through the global financial crisis, Australia didn't have a lot of the sophisticated innovations that a lot of other banks were getting themselves exposed to in the global system, and that was why there was a lot more. It was a lot more problematic when house prices in the US started to fall and so on, and subprime came to an end. We didn't seem to have a similar sort of thing. We seem to be a bit behind, but that's sometimes somewhat helpful. Okay. So there's a few bits to that. The first one is, and to go back to a remark I made, we've been quite slow in adopting AI so far. and we haven't got a very large tech sector. So the broader effect is actually at this stage it hasn't been very large. I think as we adopt more AI, it will probably lead to more efficiencies. And I think the primary jobs that are at threat are the white collar workers rather than trades or blue collar workers and so on. This is the nature of the technology that's being implemented. If you look back through history, when you get these big innovations that come along, though, usually they don't happen instantly. You don't suddenly go, well, everyone's less than you incrementally introduce these processes, you incrementally cut back on staff you need. Actually, often what happens is you cut back on hours for people, or you decide you don't need to hire that next set of graduates. And so there's time in terms of adjustment that the economy has to absorb these new changes. Now, at the same time, if you're genuinely adopting a technological innovation that actually is productivity enhancing, you're lowering the cost base of that company. And you're lowering the cost base and therefore boosting profitability. That shows up somewhere. It shows up in the business at being able to innovate in some other area or investing more in some other thing, or it shows up in higher dividends or higher share prices. And then that in and of itself starts to generate more activity as well. So it's, this is how you don't end up with the sort of what the economists would call the lump of labor fallacy, where if you only think about it in one dimension, this comes along, those jobs are going to disappear. You're kind of missing that actually the rest of the economy moves on, the cost base goes down, there's more spending in other areas. If we're not going to spend as much on legal services because lawyers can more efficiently deliver those legal services, then we have more money to spend on other things. And we might prefer to go and spend it in restaurants or cafes or on travel or at the physio, or as we get older, we want more health services. And so you generate more jobs in those areas because you've got more spending capacity because you've lowered the cost of all the other things you're doing. That's kind of that's how innovations tend to come along and affect things. We talk about it in one dimension. It's going to take those jobs out. We forget that it's going to create all these other jobs. Yeah, I think when I look at the labour market at the moment, there's some signs that the labour market's still quite tight, that it's not losing that much momentum. Job vacancies are still quite high relative to employment. Quits rates have started to rise recently, which is a sign that, Sure. But if we're talking about the macroeconomy and the aggregate labour market, the unemployment rate at the moment is at 4.5%, which is very low relative to history. Not quite as low as it was a couple of years ago, but we don't want it to be 3.5%. And when it was at 3.5%, we didn't have enough workers to do all the things we needed. That was why it was so low. We were operating well beyond our capacity. So I'd say we're about full employment right now. And I don't think the timely indicators are saying that's about to dramatically change. We're probably on some sort of gradual upward incline in the unemployment rate, but it's not going to, I don't think it's going to dramatically change. And I can't see much evidence that businesses are suddenly going, right, we've got AI, so we don't need all of those people. I don't think that's happening quite yet. I can't say it won't, but I don't think it's happening yet in the numbers that I'm aware of. I am going to stop here. Thank you for your attention. If you're interested in getting my research or keeping up with the stuff that I produce, and I encourage you, ping me on LinkedIn, because I am on LinkedIn and I put a lot of stuff up these days on LinkedIn these days. That's one way to keep in touch with me. But again, thanks for your attention.